Hello, I'm Hickey from interest.co.nz and welcome to a special report on the Reserve Bank's latest decision on the official cash rate. It left it on hold at 2.5%. Now that was as expected, and you could argue there's not much to be said more, but you can always look at the detail of the statement from the Reserve Bank to get an idea of what's going to happen to interest rates, what's happening with the economy, and what might happen with mortgage interest rates and also with the property market. So let's look first at the interest rate track. Currently, floating mortgage rates are around about 5.5% if you push your bank hard. Now the listed rates are about 5.7% and they've been there for a couple of years now. The Reserve Bank said it will keep the official cash rate on hold at the record low 2.5% until the end of this year. Economists are expecting the Reserve Bank to start increasing it from March next year. That's because inflation is currently well below the Reserve Bank's target zone of 1 to 3%. The Reserve Bank says that the economy is picking up. We're seeing more activity in the housing market and in the rebuild in Christchurch, and that's putting some inflationary pressures into the economy. But on the other side, we have a very strong currency, and the rest of the world really is struggling to get going again, so that's pushing down on prices. The end result is that the inflationary pressures are quite balanced, and there's no need for the Reserve Bank to move the official cash rate just yet. But things are picking up, and economists expect the Reserve Bank to start increasing it from around about the March quarter of next year. It may increase anything from, say, 1.5% to 2%. That would put it up to around about that 4.5% mark. That would mean floating mortgage rates would hit around about 7, maybe 6.5% within 2 to 3 years. That's if interest rates go up, and that's a big if. Remember, bank economists and others have been predicting that the Reserve Bank will be putting up interest rates pretty soon and quite quickly. They've been doing it for the last 2 to 3 years and nothing has happened. That's because there are 3 driving forces in the world keeping inflation under control. In fact, if anything, driving us more towards deflation. They are, firstly, a lot of debt hanging on top of particularly households in the developed economy, but now increasingly in some countries, government debt as well. And all sorts of studies show that it takes a long time for an economy to recover from that sort of debt load. Debt has to be repaid. In some cases, debt has to be restructured. And that keeps economies growing slower for longer than many people would think. Secondly, we have ageing populations in the developed world. As they get older, they tend to save more. They're not quite so productive. And that tends to reduce economic growth in those places with ageing populations. And New Zealand is not quite as bad as Japan, but we certainly do have an ageing population. Thirdly, in much of the developed world, incomes in the middle to lower income groups are stagnant or rising very slowly, and there's a lot of household debt to be repaid. So even though a lot of money is being printed, it's not necessarily feeding into the real economy and driving demand for jobs and wages. That means overall inflationary pressures are very weak, even though we're hearing about $6 trillion worth of money being printed around the world. That is having impacts though, and the Reserve Bank talked about it today. $6 trillion of money being printed. Now some of that's going to squirt out the sides and go to economies that don't have capital controls, that aren't printing money, and have an interest rate higher than 0%. Now that's definitely New Zealand. We don't have any controls on who can buy property here, whether you can bring your money in here, and that's helping to push the New Zealand dollar up. Now, the strong New Zealand dollar was something the Reserve Bank mentioned today, but it didn't rattle its sabres too hard because it quite likes quietly the fact the high New Zealand dollar is keeping inflation under control. And the markets, who had been a little bit worried the Reserve Bank might cut the official cash rate to try and bring the currency down, looked at the statement today and realised the Reserve Bank's bark is much worse than its bite. Also, on the housing market, the Reserve Bank was a little bit cautious today about saying whether it would hike interest rates to try and slow the housing market. It has talked about that in recent months, the risk that it would have to hike interest rates to try and slow the housing market and avoid some sort of bubble developing that could burst down the track and hit the financial sector. So no real comments about that other than to say it doesn't like the fact that house prices are rising quickly when demand outstrips supply. So overall, there we have it. Interest rates on hold, likely into the early part of next year. Inflation very subdued. The Reserve Bank unwilling to act on the currency, either to intervene or to move the official cash rate, or on the housing market. And that means interest rates are lower for longer. That also means that in those areas where supply of housing is weak, particularly Auckland and Christchurch, there's no prospect anytime soon for anyone taking some of that demand out of the market. I'm Bernard Hickey. That was a special report on the Reserve Bank's official cash rate decision here at interest.co.nz.